Optionprofessor.com is a company that has DVDs that explain the introductory, intermediate, and advanced option strategies. So we don't do any particularly specific recommendations on anything, but we do try to make sure everyone understands the uses and the risks of the different strategies, why you would use them, why you wouldn't use them, and all that type of thing. Today, what I'm going to try to do is go over a number of things that I'm seeing. Again, we're not going to give specific recommendations and never do, but from an educational point of view only, I'll be giving some opinions and I'll be giving some details on a few different things that are going on out there in the world that might be of interest to investors out there, particularly the traders. To start out with, on my screen here, I'm going to bring up a chart on the S&P 500 index, which is obviously the broad-based index of 500 different companies. And there is a daily graph. So the daily graph on this will go back to about 6 months. Excuse me, going back about 1 year. I'm sorry, about 1 year. As you can see, the S&P was trading in the third quarter of last year between about 2100 and 2150 and 2200. And then right at the end of the year after the election, we did have a big drop where they took it under 2100. And then it's been off to the races ever since. We broke 2200, which was into new highs. Then we broke 2250, stayed there for a while, 2250, 2300, took off, broke out in February above 2300. Went up to the new range, which was 2300, 2400. That stayed in that range through pretty much the second quarter. And in the third quarter here, as we've begun the third quarter and got into the end of the second quarter, we did break above the 2400 and we started staying in a range of 2400 to 2450. As you can see on Friday, we did break above the range, and now we are above the 2450 area and we're up towards 2460. So the question is are we going to enter into a new range here, maybe towards 2500? Or is this a situation where they have gotten everybody with a bit of a head fake on a breakout here? And are we going to go back into a 2350, 2450 range in the next 90 days? And of course, that will be resolving itself obviously in the weeks and months to come. The person who has been doing credit put spreads on the index, maybe 5 or 10% out of the money, has been taking advantage of the rising market without much interruption pretty much since last November. And again, no strategy works forever, but the out of the money credit put spread, where you're collecting the premium but hedging it with a long option. With a credit put spread, you sell one put. Let's just use an example here. And again, this is just an example. Say the market is at 2050 here, or 2100 back in November, and you start selling something like the 2050 put and buying the 2000 put, having a 50-point spread there, and taking in a net credit. As the market rises, obviously those options expire worthless, and you, as time goes by and they hit expiration, and then of course you would be collecting the premium. Then you maybe, when it goes up to 2200, you start doing the 2150, 2100 spread. And again, as time went by, that would be obviously decaying in premium. And then of course, when both options go to zero, you would keep the net credit. Moving up now, we're up in the 2250 area. You move your strike to 2200, 2150. And then of course, time goes by, the options expire worthless. And then in that case, you would keep the net credit. Now we move up towards 2300, 2350. You move your strike to 2250 on the sell, 2200 on the buy. And of course, as time goes by and the options expire, you keep the net credit. You keep moving up here, 2350. Now you start doing the 2300, 2250, and you're following it up. Now you're in the 2400 area, so you go to the 2350, 2300, and now we're at 2450. People might be looking towards the 2400 on the sell, 2350 on the put. That's a way that a trader could follow the trend with out-of-the-money credit put spreads collecting premium along the way. Now, that's the good news. The bad news is the risk. And if the market were to drop and you're in a 50-point credit, let's just say you did 2,400 against 2,350, and you were looking for the index to stay above 2,400. If for whatever reason it dropped, you would have a risk of the 50 points between 2,400 and 2,350 minus the credit you received. And so that would be a way for you to look at the risk on that. Obviously, since last November, the out-of-the-money credit put spread has been a strategy, with the VIX staying underneath 10 for such a, or right around 10 for such a long time. That has been a strategy that has been clearly very effective, but that's past, and past performance, we all know, is not necessarily indicative of the future results. So we have to go into each transaction fresh, knowing that the risk is fresh as well as the potential gain. So that would be an example of how people might have taken advantage of a rising market using the credit put spread, where you sell one option and then you buy the lower strike. In other words, you're buying the one strike price, you're selling the one strike price and then you're buying the one that's further out of the money so that you don't have naked or uncovered risk. And again, that's a strategy that has been effective looking backwards, but again, now is a different ball game, and now again the risk is what it is. But when you do a credit put spread, you do take in the premium on the option that you sell, and then you pay out a premium on the one you buy, and you're looking to get a net credit, and you're looking to keep the net credit, knowing fully well your risk would be the differential between the two striking prices less your net credit. Okay, so that would give you a little bit of an example of how people might have been taking advantage of this market. But again, that's a long time to be in a strategy that works. And we all know, because we've been to the rodeo a few times, that no strategy works forever. And that's why you got to be a little bit careful here. Okay, looking towards something else, obviously the markets have been very, very strong and very, very constructive. I'm showing you now the Dow Jones Transportation Average. Again, going back a bit here to the last year. And again, that made a new high on the move here this week. And so, that's another positive situation. It was trading between 9,000 and 9,500 for quite a long time, broke above the 9,500 area. When did that happen? That happened at the end of the second quarter here. And once we broke above there, we've had a good month of July so far as well. Transportation average, of course, would include your, delivery companies, UPS, FedEx, and of course would also be your airlines and things like that. So obviously that is, for your Dow theorist, that's a positive sign as well. But if you do look at a 10-year graph, I like to look at the long term. It will give you a little perspective on how far we've come. Since the crash of 2008, so in the last 9 years, we've come from 2,000 to 10,000 almost, and that's a 500% jump. So we are certainly in uncharted territories, and we are certainly in rarefied air. Doesn't mean the air could not get more rarefied, but to not be aware of how far we've come, and there has to be some of the news ahead that has been discounted a little bit. Again, the reasoning behind the strong showing and the lack of selling on any sustained basis since the Trump administration got in there really comes down to the deregulation of the banks, and that's why the banks have done pretty good in the last bit, which I'll show you in a minute. And then, of course, you're looking at the tax reform and tax cuts that are supposed to put a lot more money in corporations' pockets to either pay more dividends, like the banks have announced when they got the green light last month, and then, of course, buying back their own stock, which has been a favorite pastime of the banks for quite a long time, and also leverage lending, which is where the banks are now freer, it appears, to do a lot of leverage buyouts. So that could be much more activity, takeovers and consolidations and refunding corporate debt, which is going to be happening at the end of this year and the beginning of this next year to a big way. So that's the big thing: tax reform and tax cuts, bank dereg, And of course, infrastructure spending, fixing the roads and bridges. These are all things that are kind of on the horizon. Nothing's really gone through yet, but people are certainly counting on it. So I guess I would say the fly in the ointment might be if any of these things look like either A, they're not going to materialize, B, they're going to be watered down, or C, they're going to be delayed. The market may try to, come into play with a little bit of a correction here. My long-term moving averages on the S&P, I use the monthly graphs to get the long-term picture. Now, I'll just go and give you the 50-day average, but my monthly 200-day average on the monthlies comes in around 2,200. In this particular case, the 50-day moving average on stocks, S&P 500 index, comes in at 2,300. So there's a certain amount of real estate between where we are trading and where the 200-day average is. Now, that's the 200-day. On my monthly graphs, the 200 month moving average is coming in more, or let's just call it a long-term moving average rather than putting an actual number on it. The long-term moving averages are coming in around 2,200. So there's a lot of real estate between 2,460 and these moving averages. And so if in the next 30, 60, 90 days, some of these things that people are counting on don't materialize, it could come to pass that we could possibly see a correction if people get a little bit disenchanted. Right now, that doesn't look like it's happening, but you'd be foolish not to think that it could happen. With regards to the VIX, very important indicate on the fear index, they call it. Now, let's go back 10 years and get an idea of how low this VIX has been lately. Okay, now you can see here that we had a big spike in 08. That's where we had the crash when the VIX went to 90. We had a rogue wave happen in 2010 as well as 2011. We had a very big algorithmic rogue wave happen in 2015. And it came after some very low VIX readings. Now look at the VIX readings in the last year. Basically, after we had that spike up above 20, we have been under 20 for a long time. The VIX closed, look at that, 951. That's almost near the 52-week low. Now, the VIX under 10 had been occurring only about 11 times in the last, I don't know, like 10 years. And in the last month or so, it's been under there like 10 or 15 times. So the complacency is certainly very high. And of course, that has been because the market has been so strong and the buying has been so good. But we do know from history that sometimes the VIX can change very quickly. So again, what this would tell me is that put insurance, meaning buying a married put, that's where you have a stock you own, you've made gain on it, or you're trying to get into a stock right now and you'd like to have some protection on it. The puts probably in some cases are very, very inexpensive, and therefore your insurance is quite inexpensive. Now, I was going to show you again, because of the dereg, where some of the banks have been doing. So let's take a look at some of the banks. Let's start out with one that people are really pretty popular with right now. And again, I'm not recommending any of this. We're just talking about it. And again, this is my opinion as well. But this is certainly not a recommendation on anything like this. Citigroup, $66, $67. The high's been about 69. Okay, let's look at the last year. Okay, in the last year, Citigroup has come from as low as about 40 bucks, 45 bucks to almost 70. So, some of the news is obviously discounted up. So you have to be a little careful here, because if rates don't rise and they don't have that big gap between what they lend and what they borrow at, what they lend at and what they borrow at, it could not be as popular as far as the circumstances for the business, profitability. Looking towards, so say somebody was into this stock, right? And they bought it at 40 and it's up here now around 70, right? Okay, let's talk about theoretically, which means we're just talking about, generality here, not a specific trade. But let's see if somebody wanted to protect some of that gain. Say they thought, hey, listen, it's had a big run, it might settle back for a while. Well, let's take a look at a couple of other ones so you get a flavor for the banking sector. Let's look at JP Morgan, another big one. Okay, JP Morgan tells you here. Hold on. Okay, this has gone from about 60, 65 all the way up to 90. Okay, another big move. All right. And again, so giving you an idea on some stocks that have had big moves. Let's take a look at another banking stock, which would be Bank of America. And Bank of America has come in the last year. Oh, that's Barnes & Noble. I didn't want that. How about Bank of America, the one that I actually asked for? There you go. Oh, no, that's Boeing. The machine has a mind of its own today. One moment, please. There you go. Okay. Now, Bank of America, again, has gone from, what, 12 bucks, 14 bucks, up to as high as 25, almost 26 bucks. Now, that's a pretty big jump, right? And it seems to have been going sideways pretty much between 22 and 26 now for quite a long time. And again, that gives you a group, a sector that pretty much the popularity of has gone very, very high. So if the dereg were to get, let me show you one other one, Goldman Sachs. And this one here has gone from 150 bucks to as high as 250 bucks. And obviously it's been kind of on the defensive here for a little bit of time. Okay, so you're looking at the banking sector. There's been big jumps in it, right? Say, I'll just use Goldman Sachs as an example. Say when it goes up to 255, you say to yourself, you know what? It's had a big run. It's gone from 150 to 250. I think I want to protect myself a little bit. Couple of ways you can try to do that. One is called a married put. And on a married put, what you're doing there is you're going to get a put, buy a put against the stock you own as almost an insurance policy, right? So say you're up at 255 and you say, you know what? I've got this thing at 150. It's up at 250, 255. I think I'd like to get a 240 put. Why? Well, because it's 15 bucks out of the money. And let's say the put is not going for too much money. Let's say you go 6 months out. And let's say the put's going for $3. Okay. Now, just as an example, could be, that's not an exact trade, but let's just as an example, cost $3. Okay. So you're up 100 bucks on the stock, 105 bucks on the stock. You're going to take $3 out of that, right? And you're going to buy some insurance at 240. When you buy a put, it gives you the right, but not the obligation to sell at the strike price until it expires. Okay. So now the stock's at 255 and it's trading there, as you can see, for about a month. Let's just get the date at the bottom so you get an idea. There you go. So it goes up towards 255 in February. And then in March, it's at 255. And now it looks like it's making a little bit of a new high. And then sometime late in March, it starts fading off. And you got that put at 240. Now it drops all the way down to 210, right? Now you have the right to sell at 240. So your put is worth 30 bucks. 240 minus 210 intrinsic value, real value, 30 bucks, minus the 3 you paid, 27 net, not counting fees or commission. And there you got a good hedge going on. You could take it off there. You're still long the stock, and you just put 30 bucks in your pocket, minus the 3, 27 bucks. Now it pops back up to 225. Maybe if you think it might be rolling over because it's having trouble at that former low from January of 2017. If it is going to roll over from here, maybe you take some of that 30 bucks you made, take a look at the 210 put, maybe buy another insurance deal, right? If it goes through the roof, you're going to lose the premium. If it tanks down to 195, your 210 puts will be worth 20 bucks, 15 bucks, minus whatever you paid for them. Okay, that's why people buy married puts, because they want to have a net underneath their equity. They don't want to ride the train all the way up and then ride the train back down. That's not to say the train is going to run down, but we all know that we don't know exactly what the future holds, and that's why people buy insurance on anything, right? Now, the other thing is if this thing goes through the roof, 255, 270, 290, 310, You're still in the market, but you lose your what? Your put premium. Okay, which because you bought it down here at 150, you certainly got a little bit of money to spend on insurance, right? Or if you're just coming into the market and you want a net, you buy a put against it right away, so at least you walk around town knowing that you got a floor underneath your equity. That is why people buy the married puts. And one would have to say that there are a number of stocks, you know, that might fall into this category. Let's look at some techs. Nvidia. Nvidia is a company that obviously, if anyone knows anything about them, has been going through the roof. And a year ago it was at $45, and now it's at $165. And it is up near that high point again, around 165. 168.50 has been the high, 169. Okay. And if you bought it at 45, there's a gap there, you know, 105. I don't know if it's ever going to get filled, but, you know, there's a gap there. But, you know, this, you know, obviously the puts may be very expensive on this. You'd have to price them out, see if they make any sense economically. But you're looking at a situation where if you had a 150 put and this thing does fall apart for whatever reason, it might come in handy. Okay, let's look at Apple. Apple's at about 150 bucks. High's been about 157. Okay, say it was up at 157 and you say to yourself, you know what? Apple's had a big run. What do you mean it's had a big run? Well, it's gone from 90 bucks to 160 bucks, right? 156. And you can see it stayed flat there all through the month of May and into June. And then it broke down. Now it's come back up. But it isn't above the 150 level, and that's the breaking point. You see that low in May? So if we get above there, then that would be very good. If it rolls over from here, for all we know, it could be taken out to 142. At any rate, say a guy owns this thing, right? And they're talking about maybe delaying this new phone or some other news that might not be rosy. Up here at the 149 mark, you could investigate what the 140 puts go for, so you have a little bit of a net underneath. And then if the market does tank, you have the right to sell at 140, and that would be minus your debit, and that would be a way for you to take advantage of if it was going to drop. If the market was going to go north, you're going to lose your premium, whatever you paid for that put. Again, when you buy a put, it gives you the right but not the obligation to sell at the strike price until it expires. Risk limited to whatever you pay for the premium, plus all fees and commissions. Okay, now, if the stock goes to 160, 180, you're still in there, but you lose the put. Now, there's another strategy that some people employ when a market is what they believe at a higher point. Let's take a look at Amazon. Okay, Amazon's at $1,000. The high's been 1017. We've had three shots at the 1016 area, right? Amazon used to be 700, now it's at 1,000. Say somebody wanted to put some insurance on this, but the insurance seems to cost a lot of money, meaning the puts are very expensive. So they may want to have help to generate some cash to pay for that insurance. And they're going to have to forfeit something to get the cash. So basically, in this view, say you don't think it's going to get above 1,050 in the near term, but it could have a correction. You could sell a covered call at 1050 and take that premium you receive and maybe buy the 950. And then you've locked it into a range of 1,050 on the upside and 950 on the downside. And basically, you have a window, upside potential to 1050, and you've got a downside support, downside bottom at 950. Now, I'm just using a theoretical example. This is not a real trade, so I'm just going to use numbers so the numbers fit. You'd have to crunch your own numbers, see if the economics make any sense. Let's say the premium's 10 bucks. 950, let's say the premium's 10 bucks. You sell 1050 for 10, take the premium, buy the put at 950 for 10, that paid for the put, and now you've got a range that you're locked into for 1050 against 950. Now I'm going to take a moment here, so because I just gave you this, I want you to take a look at that graph, take a look at the strike prices I mentioned, selling the 1050 call, buying the 950 put. Take one moment here and just take a look at that. I'm going to go off air for a minute while you look at that, and then I'm going to come back on in just a minute. Okay, having looked at that now, let's go over the risk and let's go over the use. The use, to start out with, is that you're trying to protect your equity, and you don't mind giving up opportunity above 1050. That's the purpose of this trade. That's the reason you want to be doing something like this, because you're trying to bracket your equity for a period of time where you have some certainty. You have an upside potential limited to 1050, and you've got a downside risk limited to 950 in this example. Now, obviously, if the market were to get above 1050, there are some adjustments you could do. One is called rolling up your your call. And that would be buying back the call at 1050 and then selling a higher strike to open up your ceiling. That changes the original risk, so you have to crunch the numbers and see if they make sense. But that's shall we say, an adjustment people can do if they think that the ceiling is getting blown off. There are, and again, people use this type of a tactic when the premiums are very high, so they're prohibitive as far as buying a put, because let's say the calls are 25 and the puts are 25. Well, if you buy a put at 950 for 25 and don't sell the call and pay for the put at 25, your insurance doesn't even kick in till 925 because of the premium you paid. So that's one of the reasons why people do the collar. This is called a collar strategy, okay? And they use it a lot of times when the premiums are quite high to kind of level the playing field as far as the premiums are concerned. But you don't get it for free. You're putting a cap at 1050, okay? And then, of course, you do have the insurance coming in with the put at 950. Okay, so you know, when you get into high premium stuff, that's why people take a look at that kind of thing. Couple of markets that people are kind of talking about. One is the energy market. Let's take a look at XLE. Now, XLE, you can see, has had a big drop. And that's because oil had a big drop, right? So it's gone from 78 to its low of 63.29, and it's currently at 65.40. If you look at the moving averages, which I'm going to show you right now, you can see, first of all, the short interest here is 15.5%. That's pretty good, healthy short interest, which means there's some people, if the market is rising, that might buy just to cover their shorts. Now you've got the moving averages on the 50-day at around 66. So we're getting close to getting above the 50-day, but they are inverted, and that's not a good thing, meaning the 50-day is under the 200-day. So the major trend is down. But could it pop towards 70? That's not out of the picture. Anything's not out of the picture because we don't know what the future holds. But it does look like it has been trying to make a bit of a turn here. Only time will tell if it can be sustained. The volume is also picking up a little bit on a 50-day basis. As you can see, 16.8 million shares volume versus 15 million. So it's picking up a little bit. And again, some people think it's about, from low to high, about a 50% correction. So that's why some people are starting to look at the XLE or the energy sector in general, thinking there could be some support down there. There's others who think we're going to blow out $40 on crude and we're going to get a 30 handle. And if that's true, obviously this thing could probably have another rendezvous to the downside. There's also other stocks, and again, I'm not recommending any of these things. We're just talking about them in a very general sense, and these are strictly my opinions. But the next one that some people are talking about is the General Electric company, which has also been under a lot of pressure. As you can see here, it's come back down from the 32 area, actually 33 area in the last year, down to as low as, let me bring it back down up here, down to as low as around 25.85. Now it's at 26.75. Dividend yield, 358. And they have a new president who people are hoping will change things around for them, but certainly it's still on the defensive. The moving averages on that come in. Let's see. 27.79, so we're still under the 50-day, and the 200-day is 29.56. So while it is getting down towards a lower area, and they do have a new people in there, they certainly have got plenty of things to correct. But they do have some activist investors, I guess all companies do, and you're looking at a situation there where unless they do make some major changes, and they obviously could at any point. The other market that people thought was kind of hammered was the retail area. Looking at the XRT, which is the retail ETF, that also, similar to oil, is trying to find some kind of a low point of which to trade off of. And last week it had a fairly reasonable week. Some of these companies, I'll just put up a couple of them for you, like Macy's has really gone down tremendously. And so, there are some changes that some of these people might be involved in. You've gone from 45 down to a low of 20. Again, I'm not recommending any of these stocks, but certainly these are in the news, and there's the charts speak for themselves. They obviously show the past, they don't show the future, but there has been a little bit of a turn up from the 2085 mark towards 22 in the last week or so. So that is a beaten down sector. And another beaten down sector is the telecom. And there you've got AT&T, which went all the way down to where? Went from 43. Of course, they're having price wars, which is probably not the greatest thing for a company. But that went from 43, 44, all the way down to 36. Dividend's pretty big at 540. So I don't know if there's ever going to be a bounce in this thing, but you're right around the 52-week low here. So we'll have to see if that holds. But that certainly is a discounted group: retail and oil and telecom. Those ones. The tech sector, obviously, one of the big leaders, and the banks have been a leaders. But as you saw from some of the graphs, they have gone a little bit sideways. And let me show you one of the reasons why that might have been. After the election, we got this is the 10-year Treasury yield, okay? And after the election, we had a very big jump in yield, right? We went from 1.6, 1.4, boom, all the way up to 2.6. Then we go into a consolidation between 2.4, 2.3, and 2.6, and then it kind of broke back down again. A couple of reasons: inflation, nowhere to be found, and pricing power in the economy, nowhere to be found, and wage inflation, nowhere to be found. So obviously, it's hard for rates to stay up when those things are happening, and deflation seems to be the game. Why is deflation the game? Because we have some structural changes on how we go buy things. Obviously, we now have a tech industry that has attacked the retailer, and that is why the retail companies have been nailed pretty hard. The Targets, even the Walmart a little bit, but certainly the Nordstroms and the other guys, because people are just price conscious, and they know how to go on the internet and get the lowest possible price, and that's killing the margins. When you kill the margins, you kill the profitability, and that's the story. Could that story change? Of course it could change, and if it does, then obviously then it would be something to keep an eye on. But the 10-year note this week rolled over from its rally. It just had another big rally towards 240. And again, there is a plan to hike interest rates one more time this year in December. Also start unwinding the Fed book, the Fed portfolio in September. And then they're talking about 3 more hikes next year. In the absence of inflation picking up, and there's some people believe it will, wage inflation, because our employment situation is tight, could pick up, they say. And then, of course, I don't know how they're going to get pricing power in an economy where people are still very, very, price conscious and know how to get them cheaper. But if that changes, then we could take out 260 and we could get higher yields next year and the year after. Right now, that doesn't seem to be happening, but it could. It is important to note, though, if you look at the moving averages on the 10-year note, and they know that interest rates are a big part of the world, so you got to keep an eye on them. You can see here, if I can get this thing to go up, there you go. The 200-day moving average is at 2.25 yield, and the 200-day moving average is 2.26 yield. So as long as we're above 2.25 and 2.26, and we are above that right now, these moving averages may start rising and rising and rising, and higher interest rates next year and the year after may very well be in the cards. One thing I heard Janet Yellen say in her testimony, though, is that rates may not have to go substantially higher than they are now to get to neutral. And so in the absence of a dollar crisis where the dollar would drop quite a bit, or in the absence of something unknown hitting the market of a substantial nature, we may not see interest rates go substantially higher than they are now. Maybe a 3% yield on the 10-year is about as good as it gets, which is not that far from the 240, 260 that it already hit this year. So in that environment, of course, valuations are more attractive on some stocks because they're not competing against a big yield in the Treasury market. And it is positive for the stocks. But again, you can see some of these stocks have already gone up 50, 60, 100% and more. So some of the news must have been discounted because we did see a couple of companies announce this week, and Pepsi was one of them that I saw. And you can see Pepsi, after the earnings, have not gotten a big bid out of it. In fact, it was on the defensive going into earnings, and it really is just stable at best. The other one was Delta Airlines. And Delta Airlines, announced their earnings, and it is still hanging around the high point of around $55. So I think the next month to 3 months, months of August, September, and October, are going to be very, very interesting for stocks. I mean, they could go to 2,500 very quickly, but it would not shock me if the earnings news is not as good as they expect, and there's some gridlock on some of the things that people are looking for in Washington, that it could be a situation where knowing how to do the married puts so you can protect some of the values you've got, or even consider the collar strategy, where you sell the out-of-the-money call and use the premium to buy the put. Those strategies of hedging could be very important to be aware of. So the first step we always believe is education. Find out how the strategies work, understand the use and the risk of the strategy from all angles, meaning opportunity risk, real risk, tax consequence, whatever you have to look at. Understand it thoroughly before you proceed. And then after you proceed, you're proceeding with a full plate of knowledge. And that's basically what optionprofessor.com is about, is making sure you understand the use and the risk of the strategies before you proceed. And that's why I think we add real value to people with the DVDs that are available. And of course, we've been doing this for many, many, many years. Investors, right now, passive investing is very, very popular with the ETFs. Inflows into ETFs and passive investment has been tremendous. The VIX has shown a complacency index that has been, in my feeling, unprecedented. Volatility across stocks, bonds, and commodities, all asset classes, has been tremendously low, which means option premiums are fairly low on all asset classes, the commodities, the the stocks and the bonds. Now, that's on a general basis. Obviously, there's specific pockets that may not have that, but generally speaking, commodities have been very, very stable as far as price in ranges. Interest rates, you can see, have been pretty much in a range. Stocks, while they've gone a little bit higher, they're not a heck of a lot higher than they've been percentage-wise, in the last 30, 60 days or so. And so that has had an effect on the premiums. So that's why, considering defensive tactics or tactics that could, bracket your equity, give you some parameters around your equity, may not be the worst things to think about, particularly if you have gains in things where a little bit of insurance that you could lose the premium on is fairly affordable price-wise and very affordable because you've got gains in the things already. Doesn't seem like an unrealistic strategy to be aware of. Whether it's right for you, nobody knows except you and your maybe your financial advisor. But this would be the time, in my view, to investigate those type of things. Things look very good when they hear all-time high, all-time high, all-time high. There's no doubt about it. But you can see from the durable goods orders and some of the economic numbers and the GDP, and you can see from the inflation numbers that we're not exactly in the most robust time right now. So obviously the market is expecting and discounting things down the road. That's the good news. The bad news is A, there's no assurance that they're all going to come in exactly as planned. And also, it could be a situation where, things could change, and at least having some parameters or some umbrella in case it starts raining might not be a bad thing to know about. So again, the markets are doing great, and we hope you all are making very good money in the markets. My thesis and my theme today is to become aware of protecting those positions and protecting those strategies using married puts and collars. So my suggestion is to investigate that to see if it's appropriate for you. And my time is just about running out now, so I did want to thank everybody about coming today. And I hope I went over some things that might have been of help to you. And of course, we look forward to hearing from you with the optionprofessor.com DVDs, of which I did provide the content. And I hope that if you do pick them up, that they would be very helpful for you.